I think they would print it. I think you would have a bigger problem with inflation. They would balloon. I think they would likely balloon the ledger, and as a result, we'd have major inflation. And what that does is, regardless of your interest rate today or how much you paid for the house, if that happened, you're really going to be happy you bought a house because you have a real asset with a fixed rate that you owe back on it. Right now, you get to pay it back with inflated dollars, which is, by the way, exactly what the U.S. government is doing to you. Right? They're borrowing from the future, and they're paying you back with inflated dollars.
Hey, everybody. Thanks for joining in another episode of the 435 podcast. Today, we have our real estate market update for December. We got Branden and Jeff in the house. We go over data from a macro level, 30,000 foot view. We talk seller finance and what's been changing in the market that way. We talk mortgage rates. We hope you enjoy this episode. We hope it's informative, help you decide, hey, should I buy? Should I sell? Give you some insight as to what we do on a day-to-day basis. It's our business. This is what helps feed our families. So we hope you enjoy this episode. Please reach out to us. Give us a call. Go to wealth435.com to find out more or schedule a time with us. You can always call us. My cell phone, 435-767-7715. You can get my cell phone directly if you want to sit down with a strategy appointment about real estate in the next 12 months. That'd be awesome. We're looking forward to helping you enjoy this episode. We're raising money. There's a couple ways to raise money. It's December, Christmas time. You see my sweater. It's a beautiful time to give. This season is about giving and giving back to your community. As a Christian, it's about Jesus and him being our savior. But there's two great organizations in town that I want to highlight. Kony Coins for Kids. We're doing a project as Keller Williams, as a brokerage goes, where we're sponsoring some families. We want you to get involved. So if you don't know about Kony Coins for Kids, definitely reach out, see if you can financially help support them. The other is Switchpoint, our very dynamic, I don't know how we generalize this, but they're changing homelessness in Southern Utah. They're a great organization, but they're doing a food drive till December 15th. So check the description of the links below to find out all the drop-off locations. I think there's 10 different drop-off locations. You could donate money to this, but they're raising money for December 15th through December 15th. So it's another great opportunity to give if you haven't already given, but we have a great community of givers. So these are two that we like to feature. Enjoy the episode, guys. Again, make sure you like, subscribe, follow us on social media, and we'll see you out there. I was thinking about the brand of politics. Like there's different brands of politics, and for whatever reason, we've digressed into this brand of it's like it's like bullying politics. Like you have to say somebody is dumb in their response. Like if you don't insult their intelligence as a response to what somebody else says, you've like missed the opportunity.
And it's even better on social media.
It's even better. And then he said this is a horrible venue for these discussions, and that if I wanted to talk like a real adult, that I would come on the podcast to do it, which I just thought was so funny coming from here. So I said deal. I lined it up. So
are you suggesting that somebody should start a podcast to talk about more in-depth
conversations,
critical issues, and talk in depth and a long format.
Yeah, having nuance.
Social media might be better.
Somebody should start a podcast to cover that in local terms.
Well, I invited several dissenting opinions as to how the election turned out, and
let's name names.
Nobody has said that they wanted to join me. So
let's name names. The election's over.
Okay, no, we're not going to name names.
Well, I've invited people on that at least from social media side, feel like they don't agree with me or that I'm opposed to their position, and they don't want to come on and talk about it. But I'm okay. I'm open to talking to whoever about anything at any time. I'm here to learn. I don't know anything. I don't presume to know anything except for real estate. I think that's the one thing that I think we can have a solid conversation about, and I probably won't learn much from somebody that's not in the industry or know something about it. But let's get into real estate out of the gate. What do you think is the most important topic that most people want to know about real estate?
Purchasing power, i.e. interest rates.
You think that's the one that's like on top of mind? Or do you think?
I think that's top of mind for most people. I think the second on that would be there's probably a certain crowd of people that are waiting to hear about an impending collapse. Right?
I think everybody's looking for like, what are the, it's coming.
Right. Yeah.
And I keep hearing that because of this thing, the whole market's going to collapse.
Yeah. And I think a lot of that is way overplayed. I think everything's going to be okay. I think the U.S. economy is going to have an upward drift. I think we're going to solve our way out of a lot of these problems. And I don't think we're going to immediately. Yeah, I don't think we're going to have a major. I don't think we're going to have a major collapse.
What if I've said this before. I think I said this 2 months ago because we didn't do a November market update, and there wasn't a whole lot of change from November to October or from October to November. But I've said before, what would a necessary requirement for a collapse would be an absorbent supply of units, right?
Yep. Yeah.
Or like an increase, like flood to the market of units. We have outside demand comes from outside of our area to do it. So for our little micro island market, would you say a collapse in the banking, like the financial institutions, like let's say Wells Fargo or Bank of America or like a big bank collapsed, would that be a catalyst?
If Wells Fargo collapsed?
Yeah, or Bank of America or somebody that's carrying. Jeff, maybe pull up who's carrying the biggest bulk of mortgages.
JP Morgan Chase by a long shot.
Carrying the most mortgages.
I don't know about the most mortgages. That's a good point. But they're the largest bank. Not even close. I think their runner up is Wells Fargo, and it's like double the size almost. I think. But would that be a catalyst? No, I don't think that would be a catalyst. And the reason why is because I think the Fed would bail them out.
So what if the Fed didn't have any money?
I think they would print it. I think you would have a bigger problem with inflation. They would balloon. I think they would likely balloon the ledger, and as a result, we'd have major inflation. And what that does is, regardless of your interest rate today or how much you paid for the house, if that happened, you're really going to be happy you bought a house because you have a real asset with a fixed rate that you owe back on it. Right now, you get to pay it back with inflated dollars, which is, by the way, exactly what the U.S. government is doing to you. Right? They're borrowing from the future, and they're paying you back with inflated dollars.
Mm-hmm.
Right? And so when people buy real estate,
you're off. And Rocket Mortgage. They carry the most.
Carries the most. I thought you were saying who's the biggest bank, and Chase is the largest bank as a whole. But mortgage lender, yeah, Rocket Mortgage.
So these are loans closed, but who's holding them?
Yeah, is a servicer? I think the most mortgages are going to be held actually on the open market and MBSs.
So what about the private? Because I've heard some of these things about like the private market. Some of these things are being packaged up. The subprime market collapse. They were being traded on the open market.
Well, most mortgages are. Most mortgages are going to find their way. That's the whole point of.
So I guess
a conforming loan.
I was listening to like Financial Times. They ran an article about how they feel one of the worries is that the like C-class mortgages, like mortgages that aren't as good of quality, right? Okay. Like subprime mortgages.
Sure.
Those are getting packaged up with other assets and then sold in the private equity markets that we basically aren't really watching.
Is
that something?
I haven't read anything about that per se, but the fact that you have subprime mortgages getting packaged with other mortgages, that's generally speaking the broad concept of a mortgage-backed security, right? You're going to take enough mortgages and put them together that you own, effectively, right? Like tiny little pieces of a ton of mortgages. So even if that, C class that you're calling it mortgage or that subprime mortgage does have a default, you're diversified out and it doesn't affect you relative to the upside capture expectations that a subprime yield would bring into the portfolio, right? That's the idea of mortgage-backed security. Now, it doesn't always happen that way, right? Obviously, that's what got people into trouble in 2008 was the packaging of those. But there was more to it than just that, right?
So mortgage-backed securities, GSE portfolios. What's GSE? So we're looking at
your Goldman Sachs.
If you're not watching us on the video, we're looking at multifamily mortgage debt outstanding.
And multifamily mortgage debt outstanding is I mean, you gotta take that. That's something different than what we're really talking
different
about.
Classes.
Because, it's a totally different class. Those are going to be, investment properties, right? So, are we talking about somebody that owns an investment property that, the price of that property oftentimes is going to fluctuate based upon the cash flows that it produces, right? Or is it just is it someone's house, right? And the default rate on those are two totally different classes. And that's why investors typically pay a little bit higher interest rate than somebody that's buying a single family home, right? Because you're willing to let an investment property go if things get tough. You're less likely to let your own
primary
home,
residence,
right? Your primary residence go if times get tough. So
as Jeff's kind of seeking through this, and this is one thing I keep seeing people conflate, is they're saying the real estate market is doing horrible. And then the average individual who just owns their house thinks, oh, shoot, there's this commercial real estate collapse happening in like the biggest cities in the country.
Yeah.
Because the value is like 10 times less. Like we're talking pennies on the dollar for some of these commercial properties that I've seen. I follow this one guy on X, and he just does like these case studies on like this building was sold and refinanced, and then he just gave it, basically was sold for such little value. We're talking hundreds of millions of dollars less.
Yeah. A property that was bought for $300 million, say in like downtown San Francisco or something.
Now it's like 78 million.
Just sold for 78 million.
Things like that.
That's the risk of real estate, right?
But these can
happen.
There's some isolated elements here, right?
And here's the thing: where people talk about commercial real estate being this holy grail of real estate investing in a lot of ways, right? Because you can get more yield out of it, right? Tenants are less turnover historically, and all this. Like that's the risk also associated with it that people oftentimes don't talk about. So in residential real estate, you don't have necessarily that risk of that same drawdown easily happening so quick, that interest rate sensitivity. But there's other risks, right? There's always a risk. So it's about understanding what risks you have.
But seeing this commercial side, having that market collapse,
it's way different than residential.
There's a big chasm between the two things.
And here's the other point that I just thought of too, as you were talking, is when somebody says, real estate's doing horrible, right? It's all relative, right? So the market is an interesting place where you can sell me something and I can buy it, right? And we both think we got a great deal and we're both winners, right?
Win-win or no deal.
Well, and we think we're both, right? You sold that house, or whatever, because you think the market's going down, or that property because the market's going down. And I bought it because I think the market's going up or whatever, right? And we both think we're right. And so we make the trade, right? Like that's how things work in a 30,000 foot view, right? For whatever reason, you're happy, you want to sell the house, or, need to sell the house for your circumstances. And so you'll let it go and I'll buy it. But also, people's perspective of, is the market doing good or bad? Oftentimes what I find is correlated to their entry point into the market, right? So everyone says you can't time the market, but in the first 10 years out there in the market, they're wishing that they'd time the market, right? Like, so, the person that bought their home in 21 or 22 is like, man, this market sucks, right? Yeah. But the person that bought in 2020 or in 2019 or 2018 or 2017, right? All the way back to 2009. I mean,
11 would be the bottom.
So yeah, but 11, so like 12. Even before that, right? So
yeah,
even somebody that got in 06, 07 would say, man, market sucked there for a little while. But no, I think the real estate market's doing great. I've made a bunch of money on my house, right?
Right. If they held on to it that whole time, right? Which goes back into there's long tails on real estate.
Or even just say, I bought my wife and I bought our house in the very beginning of 2020, right? Is when we closed on it before COVID. And I would, in my perspective, I'd be like, yeah, that was a great trade, right? And I'm in the market still, but somebody that might be in the market but got in at a later time might be thinking, hey, I'm upside down on my house. This isn't a good market.
Right.
And so it's all perspective based upon when you got in. And if you're in long enough, the perspective seems to change, right? Because you played the game long enough and there is an upward drift to the housing market because of the inflation target of the Fed, right?
Well, and then also a lot of our economy that we found out, especially during 07, 08, as the market collapsed, is a big foundational pillar of the entire nation's economy, right? The sector, like if we were to take the entire economic sector, real estate is this massive pillar that when you topple that pillar, it knocks a ton of stuff over.
Yeah.
Where because we have so much debt that's backed into and backed by these physical assets that are real estate, right? So one of the things we've talked about, especially because the way our team sees our clients and the people that use us both for financial management, for Ducharme Financial, right? This is two separate businesses, but when we have clients and we say, hey, we want to help you understand real estate in relation to the rest of your financial strategies and management of that. When we look at just real estate as a whole, you have these milestones. You have the first time home buyer. Mm-hmm. You have the move up buyer or seller, right? You have these different segments. I got a great job. It's my first house. Now I got a raise, or I moved on and I got promoted. Now I want to upgrade my home. And then you start getting into the retirement side of things, right? You have these different segments. So when I look at this real estate market, depending on who you are, there's these milestones that it's going to be, affect people differently. But if you look at just price trends, if we step back and we say from the macro side, we're not going to get into the weeds of these individuals, these individual segments, prices month over month from an average and a median have gone up. So right now we're looking at the price trends from October 2017, all the way till November of 2023. And our median sale price right now, you want to hover over that. I think it's like at the top. Is 523,000 is the median, and the average sold price is 537,000.
That's after we scrub the data, right?
And that's after we scrub the data. So then we said, okay, we have these different milestones for entry level, move up buyers, retirees, those kinds of things. But what we thought about, we really try to say, okay, this is physical residential real estate. This is a house that already been built between 250,000 and $1 million, and we use the $1 million mark based off of basically a jumbo loan. We wouldn't say, you're going to get a conventional loan.
The upper bound of a conventional loan, grossed up for a 25% down payment, right? So, i.e., rolling equity from a prior sale in. Which came out to I think 986.
Yeah.
So we rounded up to the 1 million so that it fit the brackets of the data nice.
Yeah, the conventional loan limit right now I think is like 726,000.
Yeah,
and they're moving it up to 766 for 2024. So that's the upper side conventional loan limit.
That's the upper side of our bounds, right? So we scrub the $3-4 million properties out at Entrada so that it wouldn't skew the data.
Go to that third tab, Jeff.
And then we also put the lower limit at 250,000.
Right.
We looked at what's the average price of a 2-bed, 1-bath home, or condo in St. George Hurricane area.
Yeah, like
right?
the metro.
Not Bryan Head, not Cedar City, not Springdale,
Enterprise,
right?
Central, like this. Right. Some of these really small towns, right? We just said, hey, let's look at
in the valley.
The bulk of
what is the first level entry level home that somebody would look at? And that's 250,000. So it scraped away any of your major distressed properties, mobile homes that are secured, right? Like that's a sort of thing.
So then I also pulled up the terms of sale for the entire year. So this is just through the Washington County Board of Realtors. Conventional loans make up 50% of our market, $1 billion in listed volume. And at the average sold price at the conventional loan limit is 591,000. So that's kind of where we decided, okay, let's look at these two different things. We got almost a tale of a couple different markets, but first is 250 to $1 million. Then we looked at $1 million plus. So if you look at the market trends, go back to the price trends, your average and median price sales right in that middle 500,000. Lower 537,000 is the average, 523 is the median. Now, if you go to the $1 million plus market, Then I'll go over to price trends because I was looking at Yep. Nope. Just slide. Oh, there you go. Oh, no, go back to the tab, the million plus, and then just click on price trends. There you go. So now we see the same data set over the same period of time, only over 1 million. So the median sale over 1 million is 1.3 million, and the average is 1.6 million. And the interesting thing to me that jumps out to me in this is that between 2017 in October and now, this has not changed. Like if you're not looking at the graph as a whole, there's seemingly one outlier there in January of 21. The average sale was over 1 million was 2.99 million, and the median was 1.53. But you basically have almost a flat line over 1 million. Mm-hmm. So there's a lot of stability in the price trends over 1 million, which I think is pretty surprising to me. Is that surprising to anybody else?
No, I think you start talking about liquidity coming out of the market, right? So that market can only have so many buyers, so many sellers.
So then,
and there's just what does an annual wage increase mean to the people that have that kind of money typically, right?
Yeah, and we didn't even see. There's not even really like a COVID frenzy that happens. There's like no COVID frenzy for like prices didn't go as a whole.
Yeah, I think the only thing this doesn't speak to is the volume of homes that weren't in this bracket that are now in this bracket. So if you looked at the volume overlay
click on click on volume. That's a good segue.
Then you would probably see, right. So
that's wild to me.
So you can see where in 2019, hey, it popped up, and then there's a big lift in 2020.
Well, let's just look at the range. So go back to October of 17, and so the active volume was 29 million. Sold volume was 7 million, 7 or 8 million. Okay, let's round it up. So that was 2017. Today, active volume $391 million, and sold volume is $47 million.
But that aligns with everything else that we've been saying, which is, hey, if you're just over $1 million, you probably have some downward price pressure on your home. So a lot of those homes, in my opinion, that scooted into the $1 million category, right? They were the $700,000, $800,000, $900,000 houses that are now, $1.1 million, $1.2 million. Those have some downward pressure that they could drop back out of the $1 million category, right? Or filter.
I that might even be a little.
This looks like a bubble to me. Truthfully, like this seems like such an obvious bubble to me. But maybe I'm.
No, I don't think a bubble. I think you're just you remember there's a clean break in the data set, right? So if something drops below, if something goes from $1.1 million to 980,000, right? Because somebody brought a nice offer to the table and they wanted to sell it, it completely gets removed from the data set. And likewise, if someone bought something and it was 800, 850, and now they listed it and it's 1.1, it's going to be in this data set, right? It's going to be here in there. If it's $1,050,000, right? It'll be a home that's active listed right now. So bubble, I think, says that something could pop.
But
right?
looking at purely if we say supply and demand, aside from the units, we just look at volume, supply and demand. This is the biggest delta ever seen in Washington County.
Right. And all I'm saying is that I think you'll see downward pressure. I don't think you're going to see a bubble pop.
Okay. Fair enough. New volume over the last couple of months, we still got $81 million in volume. In the new volume, sold volume, 47 million, as I said before. So over 1 million, it seems like there's a ton of inventory. There's a ton of volume on the market right now. That's really catalyst. What was that month? Looks like August.
Yeah.
Did that start the jump off?
Yep.
Yeah. Hover over that dot. One over.
Well, I think more and more properties came to market, and
August it set it off. In August alone, it was 174 million, and so we've doubled.
Well, rates were peaking. So if you think about it,
but are rates as impacted by this?
Yes. In this demographic, I think if you scrubbed out, if we revisited this data set and scrubbed out anything over 2 million and did it between 1 million and 2 million, maybe its own data set, I think it could potentially tell a different story. Again, just looking at like, what are all those properties $1 million plus? I think a lot of them are closer to the 1 million mark than they are, say, like the $4 million mark, right? So the $4 million mark, interest rates are going to have little to no impact.
So if you go over to
somebody's decision to buy.
Because this is where I just feel like mortgages is part of the conversation. So go back to the terms of sale, third tab. So if you look at other, okay, so we have cash, financing, farm home, FHA, other, owner finance, U.S. housing, VA. Other financing, my assumption is this is a jumbo loan, but maybe not.
No, so I think it's falling. I think a lot of that low $1 million price tag, right? The 1 million, the 1.1, the 1.2, that's coming in on conventional loans that people are rolling equity forward from a prior home sale that they had a bunch of equity. And so with the equity that they're bringing to the table, they can still get a conventional loan at $750,000. Right. So you bring 500 positive forward, right? $750,000 conventional loan. That's, one and a quarter, right? $1.25 million home. And I think that's accounting for a lot of those million plus purchases.
So then another point just to jump out is the cash sales. So it's 35% of our market over this last year have been cash on the residential. This is specifically houses that are already new construction's built in here as well, but they don't really close on the MLS until they get certificate of occupancy. So this is just Washington County dwellings, residential dwellings. 35% of our market's cash. It's a little lower than I think historic average. I think historically we run on the low 40% mark, but still a $842 million in volume, almost $843 million at the average sold price of $664,000. There's a lot of cash in the market. Interestingly enough, the sold price to the original list price ratio is only 1% difference from conventional to cash. So a lot of people I've heard like, oh, well, I can get a discount if I have cash. Well, there's not as much of a discount versus conventional versus cash, at least in our market so far this year.
$11,000.
$11,000. Yeah.
I think if you
have 1% discount for cash.
I think if you have cash, but you don't want to keep it tied up, right? It may still be a good negotiating tactic, I think, to save yourself 1%, close on the home, and then finance into a mortgage, right? And get your cash back. That could be a valid strategy still. Now, that being said, I would make sure that you talk to your mortgage lender like ahead of time of doing that and make sure that everything's square so that you can
make sense that way,
right? Pull it off. But negotiating with cash, I think 1% is, on this average price, $11,000.
Okay, hovering around the term sale price, I think you make a good point. Owner financing, wow, 48 deals this year in our county, $39 million in owner financed sales, 1% of our market. The average sold price is $805,000 for an owner financing. I saw a post, Eric Gubler posted how he closed on like 4 properties, zero down. I think he took. It was a 12-month balloon. So he's got 12 months. He's going to flip properties. He's got 4 of them under contract. I was like, is this in Washington County? Like, this can't be. He's like, no, it's out of state.
Yeah.
And so, but even still, my thought was 48, that seems like a lot. So then I looked back at last year, we had 18 total owner finance deals for the whole year. And the average sold price was $410,000.
Yeah.
So this is a big part of that market. So maybe walk me through what's causing people to do seller financing, owner financing. I think there's some obvious points in here, but
I think there's some, if you're in the position to carry the note on owner financing, it could limit your exposure to downward pressure in the housing market, but still, through owning the note, carry some kind of interest, right? If it goes wrong. So worst case is you kind of end up back with the property that you already owned, hypothetically, right? There's always a worst case, but, a likely poor case, I guess. The other thing is you can potentially have some tax strategy in something like that for when you realize gains, depending on where your cost basis is at and stuff like that in the property. The other thing you can do is sometimes sell your home for more than the market would normally pay, right? Because it's all just a function of, right, price and terms, sort of thing. So by allowing somebody to get it that they couldn't qualify otherwise, right, you're kind of now writing essentially a subprime mortgage on the property yourself, and you're taking on that risk. So that could be for savvy, investors, that could be a play. And I think more people are wanting to look for that because the closing costs on that are oftentimes less than conventional methods. And so they think, hey, I can get into the property and then I can refinance, when rates come down, next year or 2 years, right? I've seen, I know I've talked to several people that have done some of those 48 deals, and it's not uncommon to have a 5 or 7 year balloon that they have to refinance out of that home. And so if you're a buyer, I would say, be really cautious about that balloon. Just in the event that, interest rates kind of stay where they're at, over that time period and the property value goes down, you want to make sure that you have the ability to refinance out of that loan. Because there may come a time where if things change in your life, that balloon's going to be due, and it's going to be due either way. And
it's going to be subject to an appraisal, right? So if let's say
it's going to be subject to an appraisal,
even in 2 years,
it's going to be subject to also you qualifying with your income at the time, right? So if your income fluctuates a lot over the next 5 years, again, if appraisal comes in low and you don't have the cash to make up the difference, right? That could be a concern, all stuff. And on the other end of that trade, remember, you have the prior homeowner that was likely happy and content with that property for the most part, and you've made payments this whole time. So they've continued to get their cash flow that they were looking for out of the property. And now there just comes a time where they can say, oh, I'll just take it back.
Yeah. They get all that money and then they just take it back.
So
I think there was some predatory stuff went on in 08 where those rates. Hold the phone on 08. I mean, I know there's predatory stuff going on in our market currently. So like, I think even as a seller finance, I think there's a limit to what first, I think there's a limit. If you got a conventional loan, I think the bank can technically call it due if you are doing a seller financing. Technically, they can call it due, right?
Yes. And also,
if they find out you're doing that,
yes,
it's possible.
And also, I believe there's some terms that you actually have to, if you're going to write the mortgage on a residential property, you have to look at some of the same guidelines that a bank would have to if it's somebody's primary residence. So if it's an investment property, I believe that's sort of waived and you can kind of do whatever. But if it's going to be somebody's primary residence, there's some due diligence that you have to do, I believe. So if you're going to be the seller and offer seller financing, it might sound really good, and you can use a third party escrow to service that loan. Right? There's companies in town that do that, but also consult with your attorney to make sure that you're also not breaking the law.
Right. Yeah, I would put my money on not necessarily just
I think
taking a real estate agent's word for it.
Yeah, don't take a real estate agent's word for anything when it comes to seller financing.
Seller financing is a little bit more complex.
As a real estate agent.
And a bunch of real estate agents are probably going to be like, oh man, you're being overly worrisome on this. But
if you're going to be on either end of a seller financing transaction, pay the money to have an attorney review the contract.
Make sure your risk is mitigated on this one, because it makes me nervous, right? You see those 48, you see a big jump, 18 properties before, 48 now, last year's 18, this year there's 48 properties. We're talking 39 million in volume that's moved in Washington County over seller finance. I can't help but think how many of those people are in a better situation than if they would have done something differently. You know what I mean? And so that's one of my concerns with seller financing.
Yes, I think oftentimes that can be the case. I'm surprised that we don't see more up there, but I think that what people are finding is that, seller financing is not all it's always cracked up to be.
Yeah.
Right? It's a unique tool, but that doesn't mean it's for everyone. So everyone would love to buy something on seller financing, right? But why would someone want to sell on seller financing, right? And if they do that, oftentimes it's because you're going to pay more for their house, right? Like there's just always that trade-off, right, of price and terms. Price and terms. Yep,
absolutely. So if we were to transition kind of quickly to mortgage rates, because I think demand is really what's driving that seller finance. I think you're having people come to sellers and saying, would you consider this? Because if I go to a bank, these are the terms that I'm stuck with. And hopefully I can negotiate with somebody that has a lower rate that locked in, 2 years ago. And now there's a delta where that seller, it makes financial sense for them to do it. So now the demand is really probably what I've seen the increase on. Jeff, remind me, like, how many have we gotten on that one property on Dover Lane? How many seller finance offers have we seen?
Yeah, so they're all subject to And there's
subject to
4, 5, 6.
Subject to, maybe just clarify.
Yeah, so it's people scrubbing data on loan limits versus potential equity and stuff like that.
And so we've had multiple seller finance that come to the seller and say, hey, we'll give you seller finance terms, and the terms are really not really in the benefit of the seller, truthfully, at this point. But the amount of like increased traffic of people calling us and saying, hey, what would you do for seller finance on this?
Right. Again, price and terms. So, hey, you can sell your property for a little bit more than, the rest of the market would pay, but
Click on the
you have to
30
carry
rate.
that risk of
30
writing
year.
the note, right? And have it being subject to and the complexities of that.
Click on the chart.
Because, as agents, we all know that if we drop the price on a home low enough, the market will just buy it, right? Somebody will come up with cash. Somebody will come up with qualified for a conventional or an FHA loan, and they'll buy it, right?
Yeah, right there, Jeff.
So if you have a property listed and all you're getting is seller finance terms, and they're kind of bad terms in your favor, it probably indicates that your home's a little overpriced.
So I think
you can sell it again at the seller finance terms, but you're taking on more risk.
Taking on more risk. So we kind of gone the macro route, right? We looked at what's the market doing as a whole. We've seen prices go up month over month, but generally have been coming down since 2022. The mortgage rates, though, looking in terms of a buyer, as we settle into demand, rates just over the last basically month have pulled back almost a full %. So what was that? 8% mark. Now this is a Mortgage News Daily website is that we're looking at, and this is an index of these rates. So this isn't everybody's specific rate is going to be unique to them based off of a bunch of different factors: credit score, debt to income ratio, history in general. But their qualification is going to determine their rate. So this is just looking at an index of all different kinds of loans that have been going out. So they look at this index. Their index says that overall we were at 8% in October 19th was that peak, and then we've seen rates ping pong down, up and down, all the way until we're at 7.1% right now as an index goes. And I think
point down.
I think the index, at least the daily, because they kind of give a daily market indication, is that we're still seeing pressure go downwards on the rate. Right? Was that what I was reading, Jeff? Negative impact, meaning, or is it going up with that? It says MBS prices are significantly weaker. So far today, this strong downward movement in MBS will most likely result in higher mortgage rates. For today. So we're seeing the market start to put upward pressure, but we're talking about a couple basis points. But I think it's interesting that quarter 4 we saw rates pull back, which is what I think we talked about couple months ago. It's like, hey, when historically
Halloween trade.
Tell me more. What do you mean by Halloween trade?
I don't know how much I can get into it on this podcast.
Okay.
Somebody can look up October effect.
But
there's a seasonality. Jeff, don't look it up right now, man. We
have to be careful, right?
There's a seasonality trend. And you layer a couple other things together. The demand for bonds in the market went up, right? Which means the yield went down, which means what you can get a new loan at is going to be a lower interest rate as a consumer, right? Mortgage rates have a correlation to the 10-year treasury, right? So it's kind of a 10-year treasury plus a premium. So it's not the exact, it's not always the exact rate, and it's not always the exact same premium, but there's a correlation. And so if there's a demand in the market for 10-year treasuries, that means the price of 10-year treasuries goes up, but that means the yield on them goes down, which then you can you can essentially take out a new bond or mortgage with a lower interest rate today, right?
Go to the jumbo,
as those have come
jumbo
down.
too.
Now, whether or not those stay low is up for debate, but I think personally that you could see a play if you're needing to get into real estate, you're needing to buy a home in the coming months or sometime quarter 1 or 2 next year is maybe a really optimal time for you to buy for a long-term purchase.
You think quarter one or right now between now and then?
Between now and the end of quarter two. Quarter three and quarter four next year, you introduce some different effects with the presidential cycle and election and the effects that could have on the market.
I thought my assumption, this is my analysis, is that the current administration is going to do, no matter whatever the political party is, but this current establishment is going to want to have a positive economic situation going into election, right? If November is the election. So if I'm going to look at this as a timeline and I'm the puppeteer, right? And I can move these levers a little bit more, I can control these levers a little bit more than other market forces. I would say I'd rather see the interest rates go up over the first part of the year to mitigate it pulling back at the end of the year.
I think it's not going to happen that way.
Fair enough. From over the course of this year,
seasonality trends and presidential cycle trends and the state of the current market, I think you're more likely to see your better interest rates next year in the first half of the year. Not saying I'm going to be right. And I'm not saying, and listen, I'm not saying that like, hey, I'm 98% certain or something. I'm saying that like, I'm 70% certain.
Go to the 30-year fixed. Go to the 30-year fixed. And then just like that 1 year, we're just looking at 1 year. So we saw rates go up from February and then started coming back in May. I'm sorry. They fell from the peak of March. So March they started pulling back, and then they started climbing back up in around April, right? So so they went up and down over the first 2 quarters of the year, and then they had a solid from basically May on. They just went up, and you think that's a similar trajectory? Is what you're saying.
Sell off in bonds will raise the interest rates.
Go back 5 years. Because then we could see, let's see, 20. Yeah, see, looking at a
5-year chart on mortgage rates is like it's have
wild
to
see how it comes down.
You have to look at a much further back because the manipulation was so. The manipulation was just so crazy, right?
It looks so crazy when you look at it going all the way back to basically the gold standard. As soon as we went off the gold standard, 1981, 18% was Freddie Mac in October of 81. And then we saw some stuff really start to pull back. And now we're at 7.3 historic average. We're basically at the average now, right? I think the historic average.
Yeah. Listen, and I don't think you're going to see, what I'm saying, I think you'll see a nice little buying opportunity for people. I'm not saying you're going to see a 4% rate. I'm not no way. I mean, technically always a way, but so highly unlikely. I'm talking about you might see a rate that starts with a 6, and I think you should potentially jump on that because there's a good chance that over the next decade, we'll see rates just bouncing between high 6s and mid 8s, right?
Yeah,
and so if you can get in to a property that you're going to live in for 5, 10, 15 years, and you can get into it in the lower bound of high 6s, that's a really sweet deal. That may come out to be a really, really sweet deal.
Yeah.
Now,
because even going back to like the downward pressure on pricing, there's just not a lot, right?
So like there's a lot of
you can't save your way. Home values going down is not going to impact your purchasing power as much as that rate.
And I always say too, people, I see so much stuff on social media about, interest rates are going to come down and then everyone's going to be buying again, right? Everyone's going to be buying.
And you're going to see a flood in the market.
And I don't know I think that's a really, single factor analysis, right? The if then. And I think if you see rates come down in a significant way, right, where everyone wants them to say like, oh, it's affordable again, right? I can do this. We're likely in a really, really big catastrophe, right? So everyone forgets that mortgage rates came down in 2007. Okay. Did you want to buy a home in 2007? And quite frankly, could you qualify to buy a home in 2007?
Yeah.
Music had stopped for some people already in 2007. So what will cause those rates to get down that far again at some point is a major economic problem, which likely, in my opinion, would affect a lot of people's ability to actually sign on the dotted line and qualify for that mortgage when the time comes.
Yeah.
So I think we're more likely to see pretty stable prices, pretty stable rates. If you got to do something, do it.
Yeah. And that goes back to like, what is your situation? So if I'm
always different.
If I'm looking to move up, you're gonna really want to look at your financial situation and say, hey, what's the risk reward on this? Mm-hmm. If I'm a first time home buyer, I think you gotta take the plunge and jump in when you can. That makes the most financial sense for you, right? And qualification is going to always be the limit. Right? If I can't qualify, you can't qualify, right? So you got to still go through a strategy session of like, I got to save this much money, I got to shut down this much debt, or I need to raise my credit score so that my qualification can get me up into a home buying range, and then pick up something that'll work. Something that might not be the perfect house for you, but it gets you into the game. It gives you stability in your housing expense, because rent.
Hopefully, right? I mean, there's. You take on a risk of maintenance costs, right? And
you do.
Tax rates going up a little bit, interest, and people will talk about that too a lot, like the interest rate or the insurance rates going up and the property taxes going up. But you don't really truly mitigate that the same way renting, because your landlord will just pass a cost through to you.
Yeah.
Right. Like that's
a good point.
It's what forces rents to go up, right? Is there's more costs involved. So
maintenance, insurance, taxes.
Yeah. So you're not always totally insulated from those, obviously, but.
Because I think your cost of living right now is higher than it's ever been.
Well, yes.
Like with the price of the house, the mortgage rate, your monthly output on ownership is more expensive than it's ever been. And in relation to the rent, I think it's something to look at.
Well, there's people that talk, and their parents will have a mortgage rate. Mom and dad have a mortgage rate, or not a rate, but a payment, right? $900 or $1,100 or whatever. Mm-hmm. Or they know somebody that has this super low payment, or, something really old, home's almost paid off, $600 payment, right? And it's like, the only reason, like that payment when they bought the home was likely more than what rent costed, right? It's just that they've been in it for so long that the rent has continued to exceed that fixed cost, that fixed mortgage price.
Yeah.
So it's, you are likely in the first several years of owning a home to be more expensive owning the home than renting. Mm-hmm. However, over the long run, I do believe that it is absolutely worth it to own your home. And what I will say is from a just planning standpoint, right? If you go to retire someday, owning having a no housing cost, or like a really minimal housing cost, right? So not having to pay rent or a mortgage is so impactful on your chances of success.
Yeah. Right. When you look at the model as a whole, that's a huge pillar, right?
Huge pillar.
Okay. So we're looking at Utah cost of living. St. George, I think, was ranked as some of the most expensive cost of living places in the country, truthfully, right now. There's not a lot that we can do about it, but other than face the reality that is what it is. So it's a tough measure to look at. I don't necessarily see a whole lot of change happening though anytime soon when it comes to that. I'm not seeing downward pressure on pricing enough to really impact that. Interest rates have pulled back a whole %, so I think it's a good opportunity for buyers. And like to your point, over the next 3 months, this is still a good window to get in. We're going to see inventory jump. Sellers are going to get off the fence after the holidays. Most of the time, sellers just don't want to sell during Christmas, right? They don't want to deal with showing the house, keeping it clean. Where do we go? What if we get an offer a couple weeks before Christmas? Then you're scrambling to do all this stuff where normally the holidays is a checkout time. So demand stays strong, but sellers typically don't want to go through that. But I think there's good opportunity for sellers. I think prices are at the highest point they're going to be over the next 12 months. That's my analysis on it. I don't know if everybody agrees or disagrees, but if I'm a seller, I think going back so we talked about the buyer and considerations there. If I'm a seller, I'm looking at where's the price trend. We're seeing, it looks like some stability in the pricing market under $1 million. Looking at the volume, going back to that volume, even, under $1 million, we still have a big delta between the active volume on the market and what's actually being sold as far as total volume goes. But this is the historically the Q4 is the low point in demand. Less people buy. in this time frame. Sellers have been pulling off the market. We've seen two months back to back where new volumes come on and less.
You know, if you also look at the active volume, it's significantly more people wanting to sell their home right now, in my opinion. And
wanting more for their home too.
Well, they might want more for it, but they're also putting it on the market. They're willing to sell it. Why is somebody willing to sell it? You know, is there a component out there that people are looking at prices coming down? Prices have come down, roughly 18% from the peak here locally, right?
Yeah, 20%. I think we're at 20.
20%. Okay. First off, if somebody's, like retirement account dropped 20%, they would want to be like doing something different, right?
Yeah, they'd want to change.
Yeah, yeah. So I think there's people out there that have gotten, same kind of concept from a behavioral standpoint. House prices are going down. They're still high. I still made money if I sell now. Let's try to do something different, right?
Yep.
Let's try to do something different. So a little bit of that fear from a behavioral standpoint. And my case is, or what I'm trying to help people understand is that when there's that fear and people want to sell, people are thinking that, housing prices have to come down. Interest rates are so high. The prices have to come down. And then you see a little bit of pullback in those interest rates momentarily. That's your opportunity to strike.
Yeah.
Right.
You got to be ready to.
And you buy, right? So, it's like Warren Buffett always said, right? Fearful when others are greedy and greedy when others are fearful, right? It's just really, really hard to go be greedy when others are fearful. But this chart,
go to the price trends on that one.
This chart is indicating that, you may be in the midst of that. And if not yet, soon.
Yeah. So, going to the peak being March, April of 22, we pulled back about 20% since then. If I'm a seller, I don't want to be chasing the ball down the hill, right? I don't want to be trying to price the home from yesterday's prices or 3 months ago. And in some cases, I've seen people that are listing. What was that house we were looking at, Jeff, where they bought it almost 18 months ago and they put it on the market for like 18% more?
Mm-hmm. Yeah, that's exactly what it was.
Yeah. So, that's not what the seller needs is one thing. But to have an agent, hopefully that agent said, hey, I think this is unlikely that this is the price. Yeah. I'm willing to go and put it on the market, which goes back to that volume. It's like you can have a bunch of houses on the market. Doesn't necessarily mean that that's actually what's going to sell.
Yep.
But, I've had so many conversations with sellers that they pick their agent based off of their ability to agree with the previously thought or want price, not based off of what the reality of the market was. And so whenever I go and sit down with a seller, I'm trying to bridge this gap between what they think the home's worth and what they want it to be worth versus what I actually think the market value of that property really is.
And for anyone listening, the value of your home is not at all what you think it is. It is only what everyone else thinks it is.
Yeah, it's only
well, not even everyone, just what other people that are qualified to buy think it is.
A buyer, ready, willing, and able buyers, willing,
and able buyer.
Really, it's one person. It's the value of what one person thinks your home is, and the person, what you're willing to do to get to that one person.
And so from one period of time to the next, right? From 6 months to the next 6 months, and historically, that's kind of how markets have transitioned. If I'm really if I'm looking at the market, and everything is dependent upon your house, right? If I have a split level home built in 1970 on a small lot, adjoining a busy road, the reality is the value of your home is significantly less today than it was in April of 22. Not just because of the conditional elements that make that property less desirable, but then you're dealing with a significantly smaller demand pool, right? So you're cutting out all of this interest in who would buy that particular property,
right?
And most buyers, what they end up doing when presented with the inventory on the market, if they don't like what they see, they just don't buy. They always have the option of just saying, oh, I'm not going to change the situation I'm in now.
Yeah.
They're not going to go above and beyond to purchase something or even write offers. I mean, there's a lot of the point where you could price your home to where the people that would actually buy it if it was in the market aren't even seeing it. It's not even an option. They go to Zillow and they say, I could buy between this and this, or I'm looking at a price per square foot. I see a lot of buyers, decide whether or not they think there's value in that home by just looking at the price per square foot. And that completely kind of messes up your ability to have people see you in the market, right? So pricing your home correctly for the market is going to tell you. I will also say this, you list your house, you don't have to sell it to a buyer that comes in with a lower purchase price, right? You don't, in some cases, even if they give you your price, you can say no based off their terms, right? They could, or their timing, right? So I think there's this assumption that, oh, well, if I list the house and somebody brings me an offer at that purchase price, then I have to take it. It's like, no, that's not the case. That's really not the case. And pricing your home in the market, you're likely to get multiple offers. We just dealt with that land property here in St. George, where it wasn't on the it was on the market, overpriced. As soon as they dropped it into value, we ended up competing against 3 other offers for a property that was on the market for 90 days.
Yeah.
Because they brought it down into the market price. So then now the seller gets to pick and choose exactly who they go with, who's the best possible buyer.
I think that property was on the market longer than that. I think it was more like 180 days.
So to the point, right, is like if you set this price too high, you end up taking a lot of time to try and actually sell it, where if you would have priced it correctly on the front end, you might not have fallen to where the ball was going. You would have cut it off at the pass, right? You ran down, the ball's rolling down the hill. You can't just keep reaching for it as it's rolling. You have to run down around it and stop the ball, right? Yeah. You can't just lean forward. So you almost have to go a little bit lower in a comfortability zone in order to stay ahead of it, because time is money, right? Time's money. So if I'm a seller, I still think we're in a great situation to sell. You're in a seller's market, especially below 600,000. If we look at specifically months of inventory, if you click on months of inventory real quick, as we start to wrap this up, months of inventory is an index of how fast is the inventory absorbing into the market. We've seen one of the biggest jumps month over month. So under 1 million, the amount of inventory went from under 3 months of inventory to just under 4. So almost a whole month of inventory, go all the way to the edge. So at the bottom, October, November 23, Jeff. 23, just the newest data. So we went from 2.8 months on the market to 2.8 months of inventory to 3.9 months of inventory. Historically speaking, anything over 4 months of inventory becomes a neutral market. There's no pressure on pricing going left or right. And then anything over 6 months of inventory is a buyer's market. There's downward pressure on pricing, right? And so
I think you're in the neutral channel right now.
We're in the neutral, but it's also a rolling 12. It's a rolling 12. So the way this is calculated is on rolling 12. It's not necessarily showing exactly whether we're a seller's market.
Sure.
But I think we've officially rolled into a neutral, and depending on the price point, if you're under 600,000, we're still in that seller's market, but we're starting to transition into a buyer's market as a whole. So we're seeing that inventory jump back to that buyer demand conversation. That's big absorption jump for a single month. I think it's one of the biggest we've seen in the last 5 years, truthfully. Any comments on the months of inventory? What else we need to wrap with? Anything else we need to talk about? Cost of living's high. Real estate market, it's complex. I think when it boils right down to it, sitting down with a real estate agent, coming up with a strategy, what makes sense for you, what's your home value worth, what's real value look like, getting with an agent that you trust that says, hey, they understand the market enough to say, this is what I think the house is actually going to sell for. And go with that data and project out a plan. Right?
Yeah.
Jeff, what do you think?
I agree. I think my bottom lines are...
We lost everybody. No, I'm just kidding. Go.
If you're a seller, I think you hit the nail on the head. If you want to get your home sold in a timely manner, then you've got to go around the ball to catch it. And then if you're a buyer, obviously depending on your scenario, but overall speaking, if you're a buyer, the next couple months, maybe 3 to 5, 6 months could be a decent time to buy, depending on your situation.
Yeah.
You will only ever know if you have a plan.
If you have a plan, give us a call. Hit us up, wealth435.com. Call us 435-767-7715. You'll get my cell phone. We could talk, set up an appointment. Calendly.com/letsgobranden. Sit down with Branden.
With an E.
Branden with an E. Should we talk? We have 5 minutes, 10 minutes. Should we talk election at all? Nah, I don't really want to.
St. George City election.
St. George City elections.
I would like to say one thing about the election, and I think we should just leave it at this. I want to thank Brad and Paula for running. They had some good ideas and really good intentions for our city. I think they're both great people, and I appreciate that they care enough about St. George to put their name out there, put their reputation out there, put in the work. I appreciate
a ton of work. Holy cow!
I appreciate all the people. I appreciate all the people that help them campaign. Right. Mm-hmm. I appreciate that they care about the community enough to be involved. And also, congratulations to the candidates that did win, Steve, Danielle, and Jimmy. I hope that they have all the tools and resources that they need to help our city be successful and run efficiently and appropriately. And I hope that, everyone gets to move forward in a way that is beneficial to the city and to the surrounding area and to all the citizens, right?
Yeah.
That is kind of what I want to leave it with. So thanks to all the people that participated, got out to vote, campaign, whatever it was. It's really important to be involved. And I was really happy to see the level of involvement that there was.
Yeah. I was hoping there'd be more, truthfully, the number of ballots, like the number of engagement. Yeah. And I haven't looked at the numbers specifically year over year as to how many people got out to vote. But we did, I think we ended up, I think it was something like 12,000 voters. I mean, it just doesn't seem like that big of a number, but
if you look at the ballot counts and stuff, I think it also tells a really interesting story that a lot of people made really well-informed voting decisions.
Yeah.
So
it was pretty close across the board.
It was
the bottom three, was within 1,000 votes.
Right. But I think, and regardless of who people voted for, I guess what I'm saying is like they all felt confident about who they were voting for.
Yeah.
Right. It seemed, in my opinion, to be very well informed, which was the hope of our podcast.
Yeah. So that's it. That's absolutely it. It was the impetus for us getting this started, and it's exciting to see that we get to keep going. I know Celeste Malloy won the Congressional District 2 seat, which I don't think was too much in question, truthfully. I think in Washington County she got like 60% of the vote, but
I think it was like even more than that.
I can't remember what the statewide was, but she's got to run again. Legitimately, like she's got to get back on the ballot. She's back on the campaign trail. She's got to do that whole thing all over again for next year. And she's going to be facing a new opposition, within the Republican Party. So we'll watch that closely. There's a Senate race, U.S. Senate race. Mitt Romney's stepping down, not running again. So we have a vacant Senate seat that's going to be next November. We'll see a governor race, right? So Governor Cox got to run this next year. So even in November, right, we're back into getting informed and staying plugged in, which is our goal of the podcast. Yeah. We're going to continue to kind of try to help have, I've already been in conversation with Celeste, bring her on, Trent Staggs, Brad Wilson, who are, Trent Staggs and Brad Wilson are running for the U.S. Senate seat. I've already talked to them about coming on the podcast, so stay tuned for some of that stuff.
I think also we hope to bring on some more stuff highlighting different local things in the community.
Yeah, local businesses.
Well, like our recent episode with Black Desert.
Yeah.
Right? Awesome episode if somebody hasn't listened to that. But just different local experts, different business owners in the area, and understanding, again, just ancillary other issues, not always just from, political candidates or whatever.
Yeah, we got an episode coming up with Zach Renstrom with the Washington County Water Conservancy District. We sat down with him for about an hour. Mm-hmm. So we got a lot of good episodes coming up. So hopefully everybody stays tuned. We're going to keep the informative podcast going. We hope you enjoyed this episode, and
see you around.
See you guys out there. Thanks, guys.